Morning, guys. Welcome to the channel. We're going to cover a couple things today and we'll get right into it. What I want to do in this video is I'm seeing a lot of comments and it's understandable, I think, but I'm seeing a lot of comments where people are basically saying that the trend is up, and the stocks are going higher, the trend is up. And what I want to do is really show people what I see in the charts, all right, that tell me that the trend is actually not up. If you have a really narrow focus on, what last week did, or what, maybe there was a really good day and stocks went higher today, you feel emotionally great because you made a bunch of money. And then you say the trend is up, the trend is your friend. And I see a lot of comments where people to me, it seems kind of lazy that people say the trend is your friend, don't fight the Fed, and that's all that matters. And then they just throw everything else out. They throw all the data out and say that none of that matters because of this. Well, okay, but what I want to do is continue to reiterate what the data says, and what I want to show you why the trend is not up. All right, look here. This is a weekly chart of the S&P 500. This is the SPY chart, and I look at everything in logarithmic scaling. That, for me, is a more accurate and technical way of reviewing the charts. It does a better job, I believe. And this is the entire bull market starting in 2009, going back to the Great Recession. And, we're way down here. And then we basically created this uptrend or bull market over the last decade, basically. And I'm going to go into detail on this, on this chart. You can see on the weekly chart how many reactions and confirmations we had of this trend line. We started right here. This is where the very first, this is basically when the trend was established. And then we had several reactions along this trend line. We had a reaction here, reaction there. As you move up, we had some more reactions right in here. And then we broke that trend line back in 2018. Let me zoom this out just a little bit. We broke that trend line back in 2018, and look at all the reactions from underneath, tagging that trend line as resistance. And this is a weekly chart, so we're looking at really the big picture thing, the big picture concepts here. When you have a weekly chart with a trend, that's a major trend, so that's something to pay attention to. 2019, and the way I was able to call the top of this market is because of this trend line. So I would suggest anybody who's following this channel should have this trend line marked out, because I use this trend line as a general thesis behind a lot of my videos. And when we change the trend, then I will change the general thesis. But for now, 2019, look, back test. And then right here, we started back testing the complete resistance tag of this trend line. As I zoom out or zoom in, you can see we came here, and this is where I put out the video where I said I think this is the top of the bull market. And ultimately, all of 2019 I said, look, we're not in a bull market anymore, we're in a bear market. Even though we're back testing, we're in a bear market. And that's because when you have a major trend like we had for 10 years, and when that trend's broken, then that is no longer a trend. You can back test, and prices can move higher on back testing of trend lines, but the major trend, the support of that trend line, has been broken. And now a back test is usually the best you can hope for. You get a back test and then it's going to fail. And that's exactly what happened. We did a full back test right here, and this is the video where I said this is the top of the market. Click the link right here. I'll put, here's a little pop-up of that video in case you're new and you haven't seen it, but you can go back and watch that video, and I'll explain to you what I was saying at that point in time and exactly what I was saying we should do. And I kept saying in that video that I think we're going to have a major sell-off right in this area, and sure enough, that's exactly what happened. So you can watch that video. But we back tested this trend line, and then we sold off. So when people in the comments say the trend is up, I go back and say, okay, fine. Maybe the trend is up on the daily chart and the hourly chart. But if you look at the weekly chart of the S&P 500, the trend is not up. All right, the trend is sideways. All right, this is a sideways range that is, the trend has been broken. And so ultimately the best you could hope for is a back test. Now, yes, we could run all the way back up to the trend line. That is completely possible, and that would be a pretty good run. So I would definitely not want to be short all the way back up 20% higher. We could easily do that and then fail again. But I just don't see that as a high probability. I see the higher probability is we've just started a bull market. The bull market is, this is we've just started a bear market. This is the bear market rally, and we're going to start to sell off. And that is more common with the pattern that we have than, breaking up to new highs and, just continuing to back test and break to new highs. And even recovering the trend line and starting a new bull market. Bear markets don't just die out in an instant. All right, they just get started. All right, we started this bear market and we've had a rally, and now we should sell off again. Let's go back and look at some other bear markets. I marked these out as well. So here's the bull market that we had before the Great Recession. And you can see we had a trend here on the weekly chart. There was a trend. It was established. When we broke that trend, just like we've broke the trend now, we had a kickback rally right here. And then this was a lot smaller. This one was only 13% after the first initial leg down. And then we continued the bear market trend, which was down. So, and then eventually you get the capitulation phase where everybody just panics. And I expect we're going to get that in this bear market as well. But the point is, once you break a trend like this, the trend is your friend, all right? But the trend is down, all right, or sideways. Best case scenario, the trend is sideways, and worst case obviously is that it's down. But the trend is no longer up. And going back to here, look, the trend was your friend to the upside here, and the trend is now your friend to the downside here. So I think the trend is your friend. You just need to trade it appropriately for what we have in these charts. Going back to this bull market here, this was the one that ran all the way up to the .com bust. And you can see that, when we broke trend right here, here's a nice impulsive sell-off right here. And it doesn't look like much on the chart, but if you measure it out, that was all the way down to the lows, was a 21% sell-off. So, not quite as big as the one we've just had. But then look at the counter trend rally. That was up 20%. So almost, the bear market rally was almost equal to the sell-off. Not quite, but it was very close. So that's what tricks people into thinking that the bear market is over, is when they don't know how to spot a bear market rally. They see the market crashing and then they see the market rallying, and they think, because they have recency bias, that they're back in this time period. They think that, oh, we're back in the trend. This is how it looked, how it felt back here. No, that's not true. I mean, we broke the trend. You get the bear market rallies. They're always in bear markets. And that's why they don't make it easy to just get short and, ride a short position down to the bottom of a bear market, because there's these vicious rallies that wipe out all the shorts. So that's why, usually when we get big moves down, big sell-off moves, I start to look to cover my short positions. I start to look for the kickback rallies and look for opportunities to get long and ride some of the bear market rallies up. But after we start to move up and start to have those rallies take place, I look to get short again. And that's what I've done on this latest rally here. Is basically, we've had the nice impulsive leg down, we've had the nice impulsive kickback rally or bear market rally, and now to me it seems like the highest probability is that we head lower, and it could grind lower over time. It's not going to just necessarily just collapse. When I put titles in my videos or in my thumbnails that we're going to have a market crash, I'm not I'm not trying to, I mean, yeah, it's a little bit clickbaity. I agree. But at the same time, all I'm trying to do is outline that I think prices are going down. If I put a thumbnail that says prices are going to move lower very slowly over time, that's boring. Nobody wants to see that. So, but what I think will happen is we'll probably start to move lower. Obviously, it's going to move a lot faster down than it moves up. That's just the nature of a bear market. But it doesn't have to just drop another 36% or 50% in a month. It might drop 50% in a year. So that's still a crash ultimately. So here's some targets. These are longer term targets on the SPY. We've got 212, which we almost hit, but we fell a little bit short. But I see 212 as a target. I see 187 as a target, and I see 153 as a target. Now, those are huge downdrafts. I know people think that's probably absurd, but the reality is when you get a bear market, you can get these kinds of downdrafts. Where do I get these targets? Well, going back to the deer market that we had back in 2014 and all the way through 2016, that is your range of that deer market. So the top end of the range is 212, bottom of the range is, about 187. You could mark it even lower down to this 181, but we'll just say 187. And then 153 actually creates the tops of the last two bull markets back in 2000 and back in 2007. Again, this is logarithmic scaling, so this is how it prints on the chart. But that creates the top of those two bull markets. So I could easily see us getting down to this 153 area if we are in a longer bigger bear market. We could easily work our way down here. Now, a lot of people put out the argument that don't fight the Fed. They just printed 3 or 6 trillion. I can't even keep track of how much money they printed. It's trillions of dollars. And I realize that. But the thing is that the Fed has done adequate. The Fed has used the adequate tools at the time that it's needed during each bear market. So in 2000 they didn't print trillions of dollars, but they dropped interest rates, and that's all that was really needed at that point in time. There wasn't as much leverage in the system that they didn't need to drop interest rate. They dropped interest rates from quite a bit. Well, let's go over there and look at these interest rates, and I'll show you the kind of stimulus they provided back then was kind of equal to maybe the stimulus that they're providing now. They just did it in a different form. Okay, so here's a chart of the historical interest rates, and I want to show you guys. Here's the dot-com bust in 2000, and you can see the interest rates were up around 6.5%. And what the Fed did to fight off that recession or stimulate the markets and economy was drop interest rates down, pretty much down to 1%. So 5.5% drop in interest rates is what is the tool that they used at that time to correct the market. And that has kind of the same effect in many ways. You're creating cheap and easy money that people can borrow, and they can borrow that money cheap and easy and then pump it into wherever they want to pump it into, whether that's the stock market or whatever. So it creates kind of the same effect. Here in 2007, they did the same thing. 5.22%, dropped it all the way down to zero, basically. So another 5%. Well, here's the thing. We don't have we never had 5% interest rates in this crash. We only had, 2.5 basically. So we didn't have the interest rates. So they dropped the interest rates to zero, but they needed more stimulus to equal the same amount of stimulus that they had back here with interest rates. And that's where the, trillions of dollars came into play. So don't be tricked, I guess, into thinking that just because the Fed printed a bunch of money that it's going to stop a bear market. Here they did the interest rates, here they did the interest rates, here they did a little bit of interest rates, and they did a lot of money printing. But that still didn't stop a bear market in 2000. That didn't stop a bear market in 2008. And I don't think it's going to stop a bear market now. So just keep that in mind. When people say don't fight the Fed, well, okay, but put the pieces of the math together, put the logical data together and understand what's happening so that You're not using just a blanket comment that is lazy. You know, it's a comment that doesn't require you to go back and look at charts and really try to analyze the market and how did the market perform, what did the Fed do back then, and how did the market perform back then. You know, it's just a thing where I think you can just, you know, don't fight the Fed, go long, and then just continue to plow money into your 401k. I mean, be my guest, but ultimately I think that's fighting against the data and the logic that I see. So, and then another thing to look at, let's look at the VIX. Let's point this out. So look, in 2008, we had a big VIX spike, and that was basically, you know, that was all during the bear market during this entire time. The VIX spiked and it was coming down, but stocks continued to fall. Well, again, we had the same thing. The VIX spiked, it's coming down, and, you know, that stocks should continue to fall in a bear market. So this just looks very similar to what we saw back in 2008, where, you know, you get the volatility spike, and then you get, you know, it starts to come down because what happens is everyone's off sides, everyone's low, you know, they're basically short volatility, and then all of a sudden you get a big crash, everybody has to flip, and so you get this huge VIX spike or volatility spike, and then everybody's kind of repositioned. You have to think like the major institutions. They are repositioned. They are either holding a lot of cash, they're either short, you know, they're repositioned for a more defensive posture. So then as that happens, the volatility starts to fall because they've all retaken up different positioning. And so you don't have that big switch or that big flip on everybody. The next crash or the next leg down, I suspect we won't have nearly the same kind of spike in volatility. Yes, volatility will rise because there are some people who are continuing to think this is a bull market, so they'll be caught off sides. But I think you'll see that a lot of the institutions are already positioned for something like that, and so you're not going to see a big spike in volatility, not nearly as big, you know, and I think that's how that will play out. So keep an eye on that. All right, guys, I think that's really it for the video. That's just what I want to point out. You know, the trend is not up. All right, the trend is sideways as of right now. I think the trend will be down. You know, will start to continue its direction down over time. But you know, when you think about, you know, if you're bullish, think about why you're bullish. What are you bullish for? In this video, I've tried to put out a case that the "Don't Fight the Fed" statement doesn't hold water with past performances. So whether you think that this time is going to be different, well, that's fine. But ultimately, that's really what I want to point out in the video. So let me know what you guys think. Let me know if you disagree with my premise here, the case I'm trying to build. And if so, why do you disagree? Let me know why you disagree. Maybe I can look at some of those reasons. Maybe I'm missing something. So thanks, guys. Catch you on the next video. Bye.